Good morning, everybody. Happy Friday. I have three graphs I want to show you today, and I want to keep it under 3 minutes, so we're going to jump right into it. In short, this was a good week for mortgage rates. Things keep seesawing back and forth. If you watched the video last week, I had told you it was kind of a bloodbath for mortgage rates, but we've got some gains back. So let me show you what we've been up to. So again, this graph should be looking familiar for everyone who's been following along this month. This has been the direction of rates in the last 6 months. This peak that we saw here was last Friday, the date I last sent you a video. This week you can see we've had some gains. A minor uptick today, but a lot of it is because the markets are starting to come around to the realization that trade talks are very different than trade deals. And the longer this talk continues without any absolute resolve, the more uncertain the markets get, and that tends to lead to lower interest rates. Now, I have been religiously reading a magazine called The Economist for the last several months. I spend about an hour or two reading it every week, and this week in their digital subscription is an article talking about inverted yield curves, and I've spoken to this in my blog posts in recent weeks, but in short, it is a common indicator of an economy going into a recession, and recessions tend to have better mortgage rates. So this is a really important topic to be looking at. Let me show you another graph that the Economist provided that shows when the yield curve inverts. Now, we don't need to talk about what that means, but when it goes red, this is an inverted yield curve. And these blue vertical bands are recessions over the last 30 years. So you can see every time the US economy has entered into a recession, the yield curve on mortgage bonds has gone into this red level. And earlier this summer, we had an inverted yield curve. Now we're popping out of it now, but as you can see in the prior 3 recessions, it popped out before we went into a recession as well. So again, recessions mean good mortgage rates. It obviously means a bad economy, but this is one of the primary driving topics that is leading me to believe that mortgage rates might be getting better in the near horizon. Whether I'm right or not, I don't know, but I'm going to harp on the point that I made last week about encouraging you to set a target for when you would want to lock an interest rate. And let me show you an example of what I'm doing for clients who are setting targets. This is a particular client that has decided that they want to lock at a specific rate when closing costs are equal to $2,700. So as time has gone on this month, I have been tracking where we are at, and you can see we are getting close, and when this blue line crosses the orange, I'm going to lock the interest rate and closing costs for the client. We're not going to think about it, we're just going to do it. Again, it's very easy to get into a gambler's mentality when the market is on a rally, and having a rate lock target is a way to objectively look at our goals, and when our goals are met, we execute them. So if we have not had a dialogue yet about setting a rate lock target, please give me a call so we can set that up. Again, I'm watching this for many clients, and it's hard to keep track if people have kind of ambiguous goals. If we have defined goals, then I feel like I can be your advocate, not just in telling you what's going on with the market, but taking advantage of it when those opportunities come. Okay, I hope to talk to you soon. Have a great weekend, and look for the next video next week. We're going to keep doing this because the market is a very volatile thing, and I want you to be on top of it. All right, bye-bye.